Hey, this is Jussi. I run a small investment firm that specializes in REIT investing, and lately a lot of you have asked me to share my thoughts about W.P Carey, which is a popular REIT that has been dropping a lot lately. In today's video, I'm going to explain to you why I believe that this is a compelling investment opportunity. I've already bought the dip and I expect to accumulate more shares over the coming weeks. But before I get into it, could you please do me a huge favor and like the video? It really helped me a lot to grow this channel. Thank you so much in advance. So let's start here with some basics to lay out the foundation. W.P Carey, ticker symbol WPC, is one of the highest quality REITs in the world. It has a multi-decade track record of significant market outperformance. It has a fortress investment grade rated balance sheet. It owns mainly industrial net lease properties, which are today very desirable. It's a pioneer of the sale and leaseback model, which allowed it to pick up assets with unusually strong lease terms over the past decades. And then finally, connected to this previous point, W.P Carey today has CPI-based rent adjustments in most of its leases, which is very positive given the high inflation that we experienced in the recent quarters. But despite all of these great attributes, W.P Carey has been one of the worst performers in the entire REIT sector over the past year. Its share price has crashed by about 40%, and this sell-off really accelerated over the past weeks after the company announced that it would spin off some of its properties into a separate REIT. The market hated this deal, but I think that it's a bit more nuanced with some pros and cons to it. The main positive of this deal is that it's going to allow W.P Carey to rapidly exit all of its office property investments. It is going to spin off about 10% of its assets, which are US-based single-tenant office net lease properties, into a separate REIT. These assets are today facing great difficulties, and despite only representing about 10% of W.P Carey's portfolio, they are hurting the market sentiment of the entire company. Therefore, getting rid of these properties should allow W.P Carey to improve its market sentiment and earn a higher valuation multiple over time. And then a second benefit from this deal is that it's going to allow W.P Carey to rapidly expand into the industrial sector. Currently, W.P Carey is already generating about 50% of its income from industrial properties, but following this spin-off, this is going to expand to about 2/3 of its revenue. This is great news because industrial properties are today performing really well. These properties are enjoying strong demand and rapid rent growth as a result of the growing trends of e-commerce and onshoring. Not surprisingly, the REIT market really likes industrial REITs, which commonly trade at fairly high valuation multiples of 20 to 25 times FFO and low dividend yields, and W.P Carey is betting that by expanding this exposure, they're also going to participate in this upside in the coming years. So overall, W.P Carey is here reducing the exposure to the worst assets, all while increasing the exposure to the best assets. This should lower risks, it should improve their growth prospects going forward, and also help their market sentiment. But there's one main negative to this deal. Since W.P Carey is spinning off about 10% of its assets, naturally its income is going to come down, and the company has decided to use this opportunity to right-size its dividend to a lower level, which will allow it to self-fund its growth going forward. This is very disappointing to a lot of income-oriented investors who had invested in W.P Carey because of its multi-decade track record of steady dividend payments. And so this is the main reason why the company's share price has been crashing lately. A lot of dividend-oriented investors just decided to exit, irrespective of the fundamentals, simply because the company is anticipated to cut its dividend. But here it's important to note that the deal overall is neutral to the value of the assets as well as the level of the cash flow. You will still own these office properties as part of a separate REIT, and the dividend policy really is just a capital allocation decision that has no impact on the value of the assets or even the level of the cash flow. Moreover, W.P Carey noted here that the dividend cut will be very small. They expect to keep their payout ratio at about 70 to 75%, which implies a cut of just 10 to 15%. This has already led to great volatility, and I think that we could see some more of it in the near term. I don't pretend to know how to time a bottom. We could see an even lower share price, but over now a multi-year horizon, I think that this is a great opportunity. To explain why, let's now go 5 years into the future. W.P Carey will then be an even higher quality net lease REIT with no office properties, mostly industrial properties enjoying even faster rent growth, and also an ability to self-fund its growth, being less reliant on the public capital market, which will overall improve its future growth prospects. And so here you need to ask yourself, do you think that the market is going to then reward this future W.P Carey with a higher or lower valuation multiple? I think that the question is pretty simple to answer. W.P Carey will be a safer REIT with better growth prospects that's less reliant on the public capital market, more desirable assets, and therefore it's going to warrant a higher valuation multiple. Today, most investors are focusing on the small dividend cut, and it's causing W.P Carey's valuation multiple to be depressed at just around 10 times its FFO, but industrial REITs are today priced at closer to 20 to 25 times in most cases. This shows you that most of the market has missed the bigger picture here, which is that W.P Carey is becoming a higher quality industrial net lease REIT that should trade at a materially higher valuation multiple, and yet today it's still heavily discounted. I think that the dividend news will likely keep on hurting the company's market sentiment in the near term, as some dividend-oriented investors decide to exit their position irrespective of the fundamentals, but over time these investors will be replaced with some others who are more total return oriented. Another net lease REIT called Agra Realty also cut its dividend in 2011, and it ruined its dividend track record in the process. But despite that, this didn't prevent the company from earning the highest valuation multiple in the net lease sector in the following years. This shows you that there is more than the dividend to a REIT. REITs are not bonds, they are total return investments, and therefore the growth is just as important, if not more, than the dividend itself. It's going to take time for this to be reflected in W.P Carey's market sentiment, but its risk profile is now improving and its growth is accelerating, both of which should warrant a higher valuation multiple, and just reaching 15 times FFO would unlock 50% upside from here. As I noted earlier, industrial REITs typically trade at much higher valuation multiples than even 15 times. They're typically closer to 20 to 25 times, and so I think that this multiple is very reasonable. And then on top of that, you'll of course also earn the dividend, which post-dividend cut should still yield around 7%. So all in all, I think that this is a clear case of short-term pain for long-term gain in the case of W.P Carey. The market is today focusing on the short-term pain, and it has caused the company's share price to crash. However, those investors who are a bit more sophisticated and can focus on the long-term prospects should be very happy about this deal, because it's going to improve the prospects of W.P Carey and help it earn a higher valuation multiple over time. I think that its risk to reward is the best it's been now in a long time, and for this reason I recently bought more shares as part of my portfolio at High Yield Landlord. Now, if you want to access the rest of my portfolio as well as all my transactions in real time, feel free to join High Yield Landlord, my REIT newsletter, for a 2-week free trial. I'll put a link to it somewhere in the description of this video. And otherwise, once more, if you thought this was valuable, if you could click the like button, that would really help me a lot to grow this channel. Thank you so much for all your support, and see you at my next one. Bye bye.